we're going to look at US versus Italy. Now, I could have picked any country in Southern Europe, but Italy is a good example. So let's look at debt, first of all. For 2-year bond yields in the US, they're about 60 basis points. In Italy, they're about 30 basis points. That's pretty good. That means that Italy's doing pretty good as far as what they pay for their debt. The deficit to GDP, that's how much debt they're adding in last year. US was 2.8% debt to GDP. Italy was only 3%. Italy doesn't have a debt problem as far as how much debt they're adding. They've done a pretty good job at cutting their budget deficits. Where they have a problem is on the GDP side. If we look at GDP in the US, real GDP in 2014 was 2.4%. Italy was negative 0.3%. But this is the next thing I really want to key on, which is inflation. That adds to your economic growth. Inflation in the US was 1.6%, and inflation in Italy was only 0.5%. You can see that inflation rate now moves the growth in total GDP for the US above the growth in their debt. That's how they're deleveraging. It's the difference in the inflation rate that is key to helping them deleverage. And it's why, when you're a central government, you care about inflation, because that is part of all about deleveraging. Now, if you look at this, you could say, well, a little inflation is good, a lot of inflation has got to be even better. To an extent, but one problem with this is if you start increasing your inflation rate beyond a certain amount, the coupon you pay on your debt is also going to go up. And the other key thing to see in this example is the fact that the inflation rate is above the interest rate the US is paying on their debt. They've manufactured negative real interest rates, which is extremely powerful for deleveraging. It's great if negative real interest rates are great if you have a lot of debt. They're terrible if you're an investor. And this is what the US is doing, and most central banks are trying to do. They're trying to take away from savers and give to borrowers. And that's what deleveraging is all about. Now, what about GDP itself? Is there anything countries like Italy can do to try and get that GDP growth stronger? Well, let's have a look and see what is GDP growth. Let's break it out. Basically, GDP growth is population growth and productivity. That's what it is. You've got to have one or both of those if you want GDP growth. Well, you're not getting any population growth going forward. Over the last 50 years, population growth for the global economy has averaged about 1.7%. It's predicted over the next 50 years to increase only 0.3%. Demographics are terrible in most of the developed and developing world, including China. In fact, the best demographics are in the US. So you're not getting it in population growth. That means you're getting it from productivity. Over the last 50 years, productivity growth has been about 1.8%. The key is, what can you do to get that higher going forward? And it's certainly an issue in Europe. It's an issue in Japan with the 3 arrows and the reforms they're trying to get through. It's happening in China as well. So this is the key thing for Europe and for countries like Italy. And it's one of the reasons why, when you look at Germany, they are so stubborn about getting the southern European countries to undertake reforms. That's why you see Chancellor Merkel so strict on this, because frankly what they're saying is they want the rest of Europe to be more like Germany. So how is that working? Because there's actually some good news coming out of Europe. We hear all the negative headlines about Greece, but there are actually some positive things that are happening in Europe that I don't think in North America we hear a lot about. So what I'm going to show you now is a chart. It's the World Bank every 5 years has a survey. It's called their survey, Ease of Doing Business Indicator. And what they do is they rank countries from 1 to 189 on how easy it is to do business in those countries. What I'm going to show is the change in these different countries' rankings, not their absolute ranking, but how much lower they are versus Germany. So starting with Portugal, in 2010, Portugal was 23 spaces below Germany. In 2015, this year, they're only 11. Spain, they were 37 places below. They're now only 19. Our Italy example, they were 53. They're now 42 spaces below. And Greece, 84 spaces below. They're now only 47 spots below. So you can see these reforms, these labor reforms, are having an impact. And we're starting to see that come through in the numbers. If you look at retail sales in the Eurozone in January, was up 1.1% month over month, almost 4% year over year. That's the highest since 2005. Manufacturing index, you can see, was 52.2 in March. Anything over 50 means your manufacturing sector is expanding. And all of these countries, Germany, Italy, Spain, were all above 50. So we are seeing some positive impact. The problem in the Eurozone, though, is this takes a toll. It's not an easy thing to do, and it's politically very tough, especially when you have youth unemployment rates of over 50%. And one of the things we worry about when we look at the Eurozone is the rise of certain fringe parties in some of these countries. And we know what happened in Greece with one of these parties, the Syriza party, getting elected and forming a new government and trying to reduce the austerity reforms that you see in Greece. There are a number of elections coming up in Spain, Greece, and Italy that are definitely going to be key, because this is a risk. If you're not able to continue on with these reforms and get the growth through productivity, there is no way a country like Italy can get their debt to GDP down and lower, like the US. And you're going to continue to have that same issue work forward in slower economic growth in the future. Now, the other thing you can do, because this is hard stuff. I mean, politically very hard. You can see this in Europe and Japan and places as well. The other thing you can do, if you have the ability, is you can depreciate your currency. So what happens when you depreciate your currency is now your exports are more attractive. They're cheaper. So all of these countries are doing something to depreciate their currency. They're either lowering interest rates or they're buying back bonds with a quantitative easing program. And notice Switzerland, Denmark, and Sweden, the three countries I showed before with the negative interest rates. That's why rates are negative. They've had to drop rates so far to try and get their currencies from appreciating and getting their currencies under control, because otherwise their economies would have slowed. That's why you see the negative interest rates. Now, the US, they're on the other side of this. They're the one lone country, again, because of the two-speed economy, that is not doing things to get their currency lower. They're actually looking at tightening monetary policy. Now, the good thing with the US, as far as how their currency reacts, a strong currency doesn't hurt the US as much because exports is a smaller percent of GDP than almost any other advanced economy, at only 13.5%. But at some point, because the US dollar has appreciated so much, so quickly, it will have an impact. And we did start to see that in the fourth quarter with net exports taking a 1.2% negative impact on GDP. So there's a limit to how far the US can increase interest rates if they choose to, and how far they can let their currency appreciate. The other country that I think it's interesting to watch is China, because China does have a lot of their economy comes from exports. And the yuan weakened 4% since October against the US dollar. But because they peg their currency against the US dollar, against their trading partners, that actually appreciated 11%. Now, this presents a problem if you rely on exports like China does, and especially given GDP is slowing in China. It was 7.5% last year. It's projected to be only 7% this year, and Chinese companies are adding a lot of debt. China is accumulating a debt problem themselves. So you're adding debt and your economy is slowing. It is not a particularly good spot to be, and a lot of people worry about how China is going to engineer a soft landing in this kind of environment. So one of the things we would worry about is if China were to do something with that peg and try and devalue the yuan to be more competitive around the world. And in fact, they have done some things. They've cut interest rates twice in the last 2 months. And I could put them on the other side of that ledger with Sweden, but again, because they're pegged to the US dollar, they do suffer from a higher yuan. Now, there's one country and one flag that is missing, and that is Canada. Because Canada lowered interest rates in January. They lowered the Bank of Canada rate 25 basis points to 75 basis points. Now, Stephen Poloz would tell you, he's governor of Bank of Canada, would tell you that he's not trying to depreciate the currency. He's not trying to talk the dollar down, but I would maintain to you that he, in fact, is a liar, because that's exactly what he's trying to do. Why do I know that? Because look at this graph from McKinsey again. This is showing household debt to income in Canada against some other major countries, and you see Canada has been accumulating debt. Well, if you're worried about too much debt, why would you cut interest rates? It's quite clear it was to get the dollar lower. Now, this is a problem in Canada, and we worry about the household debt that Canada is accumulating because, as I said before, this is going to prove to be a headwind to growth in the future as Canadian consumers deleverage. And McKinsey Global Institute has recently put out a report, and they highlighted 7 countries that they feel may have unsustainable household debt levels. And Canada was one of them. In fact, it was one they highlighted as being one of the most concerning. From Q4 2007, before the Great Recession, to Q2 2014, debt to income rose to 155% in Canada. That's up 22%. Now, so we worry about that household debt. The other thing we would worry about is the impact of lower oil prices. What is that going to do to the Canadian economy? CIBC forecasted a 35% drop in oil, and we've had more than that, would take about 0.5% off of GDP. So that is another headwind for the Canadian economy. But there are offsets, and one of them would be that lower Canadian dollar. Thank you, Stephen Poloz. The other would be a stronger U.S. economy. Having the U.S. be our largest trading partner in a recovering U.S. economy, that two-speed economy, is very positive for Canada. As well, lower oil prices help Canadian consumers. We know that Canada is a net exporter of oil, and overall that's going to hurt economic growth, but there is a benefit to some parts of the Canadian economy.